Right now, the economy is on shaky ground. This is going to affect you, potentially your neighbors, your family members, as we see layoffs pick up, as we see the supply chain break down. The first thing I want to talk about is the layoffs in relation to the economy. I'm telling you, this is important stuff. The second thing is the supply chain fallout. We're going to talk about the UK and others. And then the third thing is the real estate risk, particularly with the commercial real estate being the focus. I want to show you why this is important to you. Let's begin. Layoffs are picking up just in time for the holidays. You can look at different companies, particularly in the tech sector, that are starting to lay people off or have been through 2022. You can see the data. I pull that up for you. The layoffs tracker shows 147,000 people. You can break that down into the different companies that are there. But I do believe that when you see what's happening with tech layoffs and start to expand out further, understand why this happened in the first place. The very first aspect of that is that they actually hired too many people to not really be able to sustain that is an issue, and so at some point they have to let a percentage go. The fact remains is that these were the companies that were considered the unicorns, and they would be able to hire enough people forevermore. But now we see that with one simple change, and that is higher interest rates, everything has started to really change in the economy. Now, I believe it's important to follow the money. And when you see what's happening with individuals and their circumstances, you start to realize it's not just one thing. 401k hardship withdrawals hit record high, Vanguard says, another sign households feel the pinch of inflation. People are not going to take money out of their 401k unless they have to. We have seen the data, and it has shown that people are pulling money out of their home equity line of credit. They're using their credit cards like never before at an interest rate that we have not seen. Over 19% interest on the average credit card right now today. You can see that there is hardship that's taking place. And then we have the pension funds. I know so many people concerned about their pensions, and you could see what happened here. Well, there's a $36 billion bailout that has taken place. My goodness, this is the Central States Pension Fund. $36 billion in order to keep this from failing. That's what it shows all of this while the markets had been going up for all these years, okay? Other than a little period, through 2020, they can't make up for that. 2020 happened, they can't make up for it. They need $36 billion in this bailout. Imagine what's going to happen at some point in the future when we cannot sustain the totals that they're telling people that they can get. Yeah, we're going to get 7% per year, 7%, no problem. You as an individual, if you're not counting on that, well, you get 5%, it's okay. I'm not counting on it, but I wish I had more. If it's a pension fund, they have to, or they can't pay up the people that need the money now. They need more people coming in. It works exactly like a Ponzi. There is no difference. I want to break down what has happened historically. I want to show you this right now. I think it's really important to pay attention. An economic crisis can begin in a number of ways, but it is often the result of a financial crisis. A financial crisis occurs when there is a sudden drop in the value of financial assets, such as stocks and bonds, leading to a decline in liquidity and loss of investor confidence. This can happen due to a variety of factors, such as a sudden increase in interest rates, a sharp decline in property or stock prices, or a widespread loss of confidence in the economy. One example of an economic crisis is the Great Depression, which began in 1929 and lasted for more than a decade. The Great Depression was triggered by a series of events, including the stock market crash of 1929, a sharp decline in international trade, and widespread bank failures. The government's response, which included raising interest rates and tightening credit, only made the situation worse and led to widespread unemployment and economic hardship. In a famous quote, economist John Maynard Keynes described the economic conditions of the Great Depression as a, quote, dark and dismal time, and argued that government intervention was necessary to address the crisis. He said, quote, "The outstanding faults of the economic society in which we live are its failure to provide for full employment and its arbitrary and inequitable distribution of wealth and incomes." I think it's important to really look at who John Maynard Keynes was, obviously deep on the inside, but I believe personally that what needs to be done is to tighten our belts sometimes. Now we look at the next aspect here. The British farming industry is facing major issues across almost all sectors, with the price of animal feed and nitrogen fertilizer and fuel skyrocketing. The union warned that yields of crops will likely slump to record lows. My goodness, I read this, preparing, I read this, and now I'm reading it again, and it's still shocking me, okay? Record lows this year, with farmers also considering reducing the size of their herds. This has been going on for a while. I've been covering this analysis on the supply chain, and this is just one aspect. If you don't have food, you got people that are hungry, they go to the government. If the government doesn't give them what they need, they storm onto the streets. You have another Arab Spring, you have riots, you have civil unrest, and you have a lack of prosperity overall that simply has this self-fulfilling prophecy that is very damaging. Government faces a stark choice: back British food production to secure a homegrown supply of sustainable food, or risk seeing more empty shelves in the nation's supermarket. This is going on right now, today, on all aspects. What's occurring in the UK, but it's going on everywhere. Everywhere around the world is seeing some level of problem with the supply chain, and the food, my goodness, that should be on top of the list. This is another big one. As you see, Costco, one of the biggest shipping companies in the world, they've withdrawn its Express China, Canada, US intermodal service that was launched in October 2021 as carriers continue to trim capacity to respond to falling demand. Understand here, we've got demand destruction that's taking place. Some suggest that this is a good thing in the sense that it's going to calm inflation down. We've seen inflation on some indicators coming down from its peak, but it still gives us a little bit of insight as to how deep does it go. That's what we need to really start thinking about. And without knowing, we are going to be in deep trouble as interest rates are rising. And in a matter of days, we're going to be finding out what the Federal Reserve is going to do. Boeing lost hundreds of experienced Seattle area engineers last month. This was brought to me by a subscriber. And along with other companies, you see them cutting the workforce. We don't need as many people. We don't have the demand there. All of these things are lining up. Do you see? One after the other after the other. If you think these are all disconnected and disjointed, well then, we need to get you up to speed with what's been happening. This is Airbus. Well, the CEO is saying that he's basically warning the European aerospace suppliers are starting to move to the US to escape surging energy costs and urge governments to provide tax breaks to halt the flow. Basically saying, look, we can't do business here. Now you think about what happens to an economy when the corporations say we need to leave now because it's too expensive. Like just the thought of that is so extreme. That means your job, even if you think, hey, I'm in manufacturing, I'm good. Hey, I'm in this industry, no, I'm fine. Well, jobs are fine. Look at what's occurring. Something like the energy crisis could potentially affect so many jobs down the line, from a coffee shop all the way up to manufacturing airplanes. Remote work wipes. This is the big one, by the way. This is the topic that I've been talking about this since 2020, highlighting it very consistently. If you've been on the channel, you've seen that, and that is commercial real estate. Remote work wipes $453 billion off office real estate. Now that's extreme. Now we have the data. I've been talking about how this is coming, Now we have the actual numbers behind that. And this is for obvious reasons. I'm going to do a full breakdown. Stick with me. I'll explain what I'm talking about with commercial real estate, what are the potential pitfalls right here and now. But I just want to show you that in data terms. $453 billion. You don't need as much real estate as was produced. And guess what? There are cranes everywhere already in the middle of building more. And that's not a good thing. Okay. You can see here the surge in remote work and a decline in demand for office space, basically since 2020, apparently wiped an estimated $453 billion off commercial real estate value. That's not good for investors and pension funds relying on the value of these buildings. It goes on to more data in there. I'll just break it down more simply in a couple of minutes. I wanted to highlight the fact that this is going to affect you. You've got a pension fund, it's going to affect you. You are an investor, it's going to affect you. You see here, how have the downtowns recovered since 2020? Obviously, a lot of people don't go to work anymore. A lot of businesses changed. They said, we are now permanently keeping people staying home. And the one at the bottom of the list is San Francisco, 31%. 31%. So a lot of people, tech industry, all right, guys, we're just going to stay home from now on. And that's good if you like staying home, but not for the economy as a whole, I do believe. Top of the list, by the way, is Columbus, 112%. So it's kind of better than it was before. You could see new leases signed has declined considerably over the last basically, the chart goes back from 2015, but we're looking at this from the beginning of 2020, quite extreme. And then we move into what's happening with vehicles. You look at the Manheim Used Vehicle Index, and that surged upward as people needed to get a car. They were buying used vehicles. Things were kind of crazy. We're now back down to the levels of 2021. So that's important. Hasn't come down, back to where we were 2019, but still it's coming down. That tells us that the prices and the demand essentially have declined. And that extends out further, that's US, but if you look at China, car sales in China drop as lockdowns kept buyers at home, just with other aspects too. You look at the manufacturing, you look at the shipping, exports, imports, all of those numbers are down in China as well. And then you have certain companies. The reason I mention all these things, look, if you're an investor in this company, Carvana, basically going out of business, it looks like, or bankrupt, and maybe they'll get split up and so on. You see one of these victims, they were so loved at one point, so loved. And yet you see people that would tout one stock or another, but to me, it shows how vulnerable many can be at a time in which things are, oh, so fantastic. Let me break this down for you right here and now. Some potential consequences that may occur if commercial real estate vacancies were to rise very high include struggles for commercial landlords to obtain loans. If commercial landlords cannot get loans, they may be less able to cut deals with tenants and help them get through challenging times. This could potentially lead to more business failures and further tighten the market. Challenges for the retail and office space industries. As JP Morgan has suggested, the future of both the retail and office space industries is currently unclear, and a rise in commercial real estate vacancies could exacerbate this uncertainty. Impact on the overall economy. A rise in commercial real estate vacancies could potentially have wider economic implications, as a high level of vacancies can indicate a lack of demand for commercial space and potentially signal a slowdown in economic activity. Possible impact on property values. A rise in interest rates can potentially lead to a decrease in property values. If commercial real estate vacancies were to rise very high, this could potentially lead to a decrease in property values as well. It is worth noting that in the past, commercial real estate markets have been able to withstand high interest rates without experiencing significant negative effects. As the economist John Maynard Keynes famously said, quote, "Interest determines the normal rate of return on capital in the long run." In other words, while interest rates can impact the market in the short term, they may not necessarily have a long-term impact on commercial real estate values. At least That's what they believe. I'm not telling you what to believe in this case, but understand that if interest rates actually rise to a level and are able to be sustained there for many, many more months and even potentially years, then everything is on the table. We're talking about the potential for a crisis of more layoffs, of higher vacancy rates, of lower real estate prices, and everything in between. If you found this video informative, all I ask is that you hit that subscribe button down below, hit the like on your way out. Every single day I'm putting out information that you need to know as an individual, and I want to see you down here tomorrow. Hit that subscribe. I'll see you then. Take care.